Welcome to our eSignal Weekly Forex and Futures Forecast. My name is Jay Norris. I teach trading at Trading University. First market we'll take a look at will be the Australian US dollar. Aus-US dollar, they had it on the ropes later in the week and it recovered pretty good. Here you can see Friday's candle, big long wick, basically support held. And now they're going to make another run at resistance just above 72 even. That's a pretty big level, by the way, though. From our perspective, we're definitely interested in swing trading, position trading signals at that level. However, before you can get that signal, you need to see a slowdown in momentum, a shift in momentum south. Here, easier to see on a 4-hour chart. Yeah, something like here where you can see it rolls over. Similar here, you had a double top just below it rolls over. On the other hand, if it just zips right through there, then you've got more room on the upside. So Aussie dollar definitely here's the level to watch. As I said, just above 72 even, but you're not going to sell it there blindly. You need a shift in momentum at that level, some kind of an indication that it's getting ready to roll lower there. Next market, dollar Swiss. Dollar Swiss, we love this market from a longer term perspective. You can see it once again, it held support, a lot of support down here. We technically love this level longer term. Shorter term though, it's been volatile lately with weakness in the US stock market, and we just see overall that as being an opportunity here. I've been a broken record with the long term chart here. You can see it in your primary pattern, your secondary pattern, all up. You're breaking, you're coming above long-term resistance. Wow, that's a monthly chart, by the way. So we feel there's plenty of room up above in dollar Swiss. Short term though, you're just slogging along sideways here. We think the long term is the way to focus there. I think any dip you got to buy. We think any dip is worth buying and using leverage also. Dollar index, similar story in the dollar index. It's kind of interesting. You had a short-term shift up in the shorter-term patterns that 1 week and that 12-day, 2-week, 2.5-week pattern. It looked pretty good short-term, but again, you slide off in a sideways market. It's kind of no surprise you had a little bit of weakness ahead of the weekend. A lot of times you'll see a move stall Thursday into Friday. You get position squaring ahead of the weekend. The thing to focus on, similar to the dollar Swiss, is that secondary and that primary are up. Long-term patterns are up. They're bullish. I think that the short-term headwinds are going to come from U.S. economic numbers. Here's the funny thing about economic numbers. They tend to be rear-view mirror indicators, meaning you're looking at January numbers right now. Definitely, without a doubt, this is the slowest time of the year in the U.S., January, February, the beginning of March. So, even your March numbers are going to be looked back into February. So, I think you'll any ground you make, you tend to hit headwinds, and you'll tend to see corrections lower off of lousy U.S. economic data, which again, that's definitely a rear view mirror indicator. The thing to focus on now is the long term and what's going to be happening very shortly as far as U.S. economy getting that spring pickup. You definitely get that powerful seasonal spring pickup. So I think that's what's going to propel this guy a lot higher, similar with dollar Swiss. And you just have to be patient, and your focus has to be on buying dips here. But at the same time, you have to have enough skin in the game. Whereas if this guy does motor higher, which we think it's a matter of when, not if, that you have enough on there to make it fun for you to be profitable. So essentially, you're buying dips. And there's nothing wrong with taking off, half to 2/3 of that position on the rallies at a profit. On the other hand, you want to try to maintain some kind of a position in case it takes off. Euro, really the same story on the downside. There you had a nice move there against resistance. We would expect that. This, by the way, was secondary resistance. That's like 9-month resistance. That's a big level. Here you can see the short term's down, the long term's down, but that intermediate term there, the 60-day and the 30-day, they're still up. Those are pretty powerful patterns. Again, I think your headwinds come here. If you're trying to make headway on the downside, I think you will overall longer term. But again, you'll run into bad U.S. numbers, and that'll support the euro in here. So I almost see this guy sideways for now. But again, same story. You want to sell rallies, and you want to maintain a long-term short position also. U.S. stock market. This is going to benefit the dollar here's the daily chart. You got a nice double bottom here. Now, here's the way I like a double bottom. See how the moving averages turned up here and they turned back down here. I don't like to see a double bottom where you just get one big turn of the moving averages. Here you went up, you went down, and then you went up again. So that's a nice clean double bottom here that you made in a zone too at the 50% retracement of the breakout level back in 2013, 2014 was it? But here's a nice double bottom, and then go to the weekly chart, and that double bottom turns into the right leg of a larger double bottom. So self-similar patterns, you love seeing that as a technician. And there it is. And here's, you take that breakout all the way back to 2013, and you had a 50% retracement of that. Now you have a nice double bottom on that level. So we think the stock market is out of the woods here. We see that as being U.S. dollar supportive also. Take a look at the gold market. Boy, gold, you know, I every now and again I'll take a look at trading this guy, and I think this is now the time to take a look at a gold trade. You're just below resistance there, long-term resistance, and it shot up so quick it never gave a signal otherwise. Here you had a resistance level here. Look at how it just gapped above it, and again, we don't take a signal unless it hits a level. Momentum starts to wane, you start to turn lower. Shorter term, you never had that. You gapped right above that, so never had a sell signal in this guy, and then it just jumped and rallied like heck there. And look at the, you know, that's pretty powerful, pretty heady resistance up there. So I may be enticed to take a shot at shorting this. You know, you get the right setup, you get a lower risk, a high reward, lower risk setup here. Here's a 4-hour chart. Take a look at that. Yeah, it's just starting to roll over there. So, you know, if you get an opportunity where you see it rolling over and you can put a tight stop on there, I think short gold using leverage is going to be an interesting play, interesting trade in here. And ideally, you do it with a couple of contracts. You got those smaller contracts too. You do it with a couple of contracts, and you know, you get into the chips. You get a profit on them. Maybe take a profit on one and try to keep one in your back pocket. Short one longer term. Let that trade turn into a position, and that could be a pretty profitable trade because this is a pretty big rally. You're selling there, and you're pretty low risk. I got to think up at the top here, up above from 1240 up to 1260. Last market, we'll take a look at U.S. interest rates. This is the 10-year note, and you have to see this guy on a weekly chart to really catch scale here. Here's the top of the bond market. Okay, this is when interest rates were approaching zero. Then you had the reversal. Okay, that's the beginning of the downtrend, right? Then you have one last kickback here, albeit longer term. You know, look at this, a weekly chart. Look at that, 2015, 2016 now. You're running up there. And here's the key, what I want you to notice. You're not able to close above that 2/3 level. That's a very important level there. So long-term interest rates not able to close, I should say 10-year note, the opposite of interest rates. Interest rates are going much lower here as the 10-year market's rallying, but they're not holding those gains. Look at that big wick. So, you know, we think the die is cast for higher interest rates with the Fed's action. On the other hand, you're not going to see them make their next move until you see decent U.S. economic numbers, and you're not going to see that till you get into the spring. It really depends if you get an early spring or not. If you get an early spring here in the U.S., particularly the Midwest and the East Coast, the Northeast Coast, hey, you're going to have a pretty good sell-off of the 10-year notes. The Fed's going to have ample reason to raise rates. You'll probably see a steady, stable U.S. stock market, and you'll see a strong U.S. dollar. Thank you so much. My name is Jay Norris. I teach trading at Trading University, and we'll see you next week.